On January 30th, 2026, the market did something violent. Gold fell so hard it looked like a system glitch. Silver got hit even worse. People watched red candles, margin calls, liquidations, the whole thing. But that same day, while everyone was staring at price charts like they were heart monitors, something else quietly happened in the background. The U.S. Department of Justice posted a massive dump of Jeffrey Epstein files online. Millions of pages. Most people will never open them. Most people wouldn't know where to start. And inside that ocean of documents, there's a small detail that matters for one reason. Not because it proves anything, but because it exposes how fragile trust is when the numbers get big. Here's the clean way to look at this. There's an email, dated June 18th, 2011. It's one of those forwarded emails, subject line referencing a publication name. It points to an article with an explosive headline about Fort Knox and missing U.S. gold. Now pause. If you're hoping I'm about to tell you Fort Knox is empty, stop right there. That's not what we do. That article comes from a low credibility source. It's the kind of thing that gets shared because it's dramatic, not because it's verified. It makes claims that have never been confirmed, secret reports, fake bars, wild accusations. So forget the article. Treat it like background noise. The real story isn't the forwarded conspiracy headline. The real story is the uncomfortable, boring, documented part underneath it. Because you don't need any conspiracy theory to ask a simple question. If something is important, why is it so hard to verify? Fort Knox is supposed to be the most famous gold vault on Earth. The symbol, the final backstop, the thing everyone points to when the word trust comes up. And yet, when you look at the audit trail, it's not clean. It's not modern. It's not what you'd expect for something worth hundreds of billions of dollars. The last full, comprehensive audit people point to goes back to the 1950s. That's not a few years ago. That's before most of your grandparents had a credit card. Since then, there have been visits, tours, photo ops, officials walking in, walking out, saying some version of it's fine. But a real audit isn't a tour. A real audit means a full count, independent oversight, clear documentation, random sampling, testing bars, not just looking at sealed compartments and paperwork. And right now, the public-facing version of Trust Us is built on a lot of gaps. That alone would be a niche story that only gold nerds care about, until you add one more ingredient: silence. In 2025, this topic hit mainstream conversation because powerful people openly talked about checking Fort Knox. Big names, big microphones, big promises. And then, the conversation went quiet. That pattern matters. Not because silence is proof of wrongdoing, but because silence is how institutions handle topics that are politically messy. If you're a regular person, think about it like this. If your bank said, "Don't worry, your money is there," but refused to show any clear proof, and every time someone asked for proof, the bank either dodged the question or changed the subject, how would you feel? You wouldn't need a conspiracy theory. You just feel uneasy. That's the emotional mechanics of this story. And the gold market runs on emotional mechanics just as much as it runs on interest rates and currency moves. Here's why this is happening right now, in 2026. The world is already on edge. Debt is huge. Trust in institutions is thin. People are tired of being told everything is fine, while their cost of living says otherwise. So when a big news event drops, like millions of pages of files going online, people don't process it like lawyers. They process it like humans. They search, they skim, they see a phrase like Fort Knox, and they go, "Wait, has anyone actually checked that?" And once that question enters the bloodstream, it doesn't matter how many times someone says, "It's fine." The doubt is already planted. That's how demand is created in gold. Not by a chart, by a feeling. Gold is the asset people buy when they don't want to argue, when they don't want to debate policy, when they don't want to depend on somebody else's promise. It's not that gold is magical. It's that gold is simple. You either have it or you don't. Now zoom out and watch how the incentives line up. The US government still reports its gold on the books at an old official price, hundreds of dollars an ounce, while the market price is around $5,000. That gap is real. It's not a rumor. It's accounting. And when you're staring at a giant national debt and you're trying to make balance sheets look less ugly, the idea of revaluing gold starts to look tempting. Not because it fixes everything. It doesn't. But because it's one of the few levers that creates a big number without raising taxes overnight. So when people hear 10,000 gold, they think it's just a crazy prediction. Sometimes it's not a prediction. Sometimes it's a direction of travel created by incentives. More debt, more stress, more need for credibility, more reasons for central banks to hold something that isn't tied to anyone else's promises. And that's before we even talk about the bigger global shift. Countries buying gold steadily, building payment systems, reducing reliance on the dollar in small steps that add up over time. This is what makes the Epstein email angle powerful, even though the forwarded article is not reliable. Because the email acts like a spark in a room that already smells like gasoline. It doesn't have to prove anything. It just has to remind people that they can't personally verify the biggest vault on Earth. And once you remind people of that, you change behavior. People start wanting their own proof, their own hedge, their own insurance. In the next part, I'm going to connect 3 clean dots. No speculation required. Why the Fort Knox audit gap is a trust problem, not a gold problem. Why that trust problem creates real demand pressure, and why, in a world that's already shifting toward physical reserves, the path to much higher gold prices doesn't require a fantasy scenario. Just normal incentives, normal fear, and normal human behavior. Now let's take the emotion out of it and slow this down, because this story only sounds dramatic if you rush it. At its core, this isn't about Epstein. It's not even really about Fort Knox. It's about trust. Every financial system runs on trust. Currency works because people agree it works. Bonds work because people believe they'll be paid back. Banks work because depositors assume their money will be there tomorrow. Gold enters the picture when that trust starts to wobble. Not collapse. Wobble. You don't need a crisis. You just need uncertainty. And that's exactly where we are. Look at how people reacted to the crash on January 30th. Gold and silver didn't just fall. They fell fast. That speed matters more than the size. Fast drops create panic. Panic creates forced selling. Forced selling makes price action look irrational. But here's the key thing most people miss. After the crash, the big players didn't walk away. They leaned in. Banks didn't downgrade gold. Central banks didn't pause buying. Research firms didn't say this was the top. They said the opposite. That tells you something. Institutions don't care about headlines. They care about structure. And structurally, nothing changed. The world is still loaded with debt. Governments still run deficits. Central banks still need credibility. Trade is still fragmenting. Supply chains are still fragile. So when a shock hits and prices reset, it doesn't erase the reason people wanted gold in the first place. It just shakes out weak hands. Now bring Fort Knox back into the picture, but keep it grounded. Imagine you're running a system this large. Hundreds of billions in gold. Decades of legacy accounting. No modern audit trail that satisfies a skeptical public. Do you rush to open the vault and live stream it? Or do you avoid the topic entirely because even a small irregularity would create chaos? That's the uncomfortable reality of scale. At a certain size, transparency becomes risky. Not because something must be wrong, but because expectations are absolute. If you open the door, people expect perfection. Every bar accounted for. Every serial number clean. Every test flawless. Anything less becomes a scandal. So institutions default to silence. Silence isn't proof of absence, but it's also not reassurance. And markets don't like ambiguity. Here's where psychology kicks in. When people hear, the gold is there, trust us, but can't independently verify it, they don't immediately assume fraud. They assume fragility. They assume, if something went wrong, it would be a mess. And once that thought exists, behavior shifts. People don't sell everything and move to bunkers. They quietly add insurance. They buy a little gold, a little silver, a little something outside the system. That slow, steady shift is how bull markets are built. Not with panic buying, with quiet accumulation. This is why the idea of gold revaluation matters so much. Right now, the US values its gold at a price that has nothing to do with reality. It's an accounting artifact from another era. That doesn't matter until it does. When debt gets large enough, every line item gets reconsidered. And gold is one of the few assets on the government's balance sheet that can be adjusted upward without issuing new debt or raising taxes. Revaluing gold doesn't create real wealth out of thin air, but it does change optics. It strengthens the balance sheet on paper. It signals stability. It tells creditors, we still have real assets. That's powerful in a world where confidence is currency. Now zoom out globally. Other countries aren't waiting for clarity from the US. They're acting. They're diversifying reserves. They're buying gold month after month. They're setting up payment systems that don't rely on a single currency. They're not doing this because of one email. They're doing it because the post-World War II financial order is aging. And aging systems don't break all at once. They creak. They strain. They get patched. Gold thrives in that environment. Not because it's exciting, because it's boring. Gold doesn't promise growth. It doesn't promise yield. It doesn't promise innovation. It promises one thing: permanence. Now let's talk about the number everyone fixates on: $10,000 an ounce. That sounds insane until you frame it properly. That number doesn't require hyperinflation. It doesn't require collapse. It doesn't require missing gold. It requires time, revaluation, and sustained demand from institutions that don't trade on emotion. If central banks keep buying, if governments quietly prefer higher gold prices for balance sheet reasons, if trust continues to erode slowly instead of dramatically, higher prices become logical, not sensational. And this is where the January crash flips from disaster to signal. Crashes reset narratives. They expose who's trading momentum and who's thinking long-term. After the worst gold crash in decades, the fact that institutional confidence stayed intact tells you the floor is psychological, not technical. And that floor rises over time. Here's the part that really matters for regular people. You don't need to know if Fort Knox is full to understand this trade. You just need to recognize that nobody wants to prove it. And in markets, what people avoid proving is often more powerful than what they loudly deny. Because avoidance signals risk management, not confidence. That's why the Epstein email is a footnote, not a smoking gun. It didn't create doubt. It revealed how little proof exists to remove doubt. And once doubt exists, gold doesn't need hype. It just needs patience. In the final part, I'll tie this together with one last piece: why this moment feels early, not late, and why the biggest moves in gold historically didn't come when everyone was panicking, but when most people were distracted. Let's finish this by talking about timing, because that's where most people get this wrong. When people think about big moves in gold, they imagine chaos. Sirens, breaking news, markets on fire, everyone rushing at the same time. That's almost never how it actually happens. The silence from powerful institutions doesn't scream collapse. It whispers risk, and risk is all gold needs. Now add China back into the frame, not as a villain or savior, but as a rational actor. China isn't buying gold because of headlines. It's buying because it wants options. Options away from the dollar. Options away from sanctions. Options away from systems it doesn't control. Every central bank understands this logic. Gold isn't about replacing the dollar tomorrow. It's about reducing dependence quietly over time. That's why gold buying doesn't spike one month and vanish the next. It's steady, boring, persistent, and that steady demand doesn't care about daily price swings. It cares about availability. Now combine that with supply that doesn't respond quickly, and you have upward pressure that doesn't announce itself loudly. It just keeps showing up. This is where people make the mistake of asking, is now the top or the bottom? That's the wrong question. The right question is this the beginning of a longer shift in how trust is priced? And all signs point to yes. Trust used to be cheap. You could outsource it to banks, governments, and institutions without thinking twice. Now trust is expensive. It has to be earned, verified, or replaced with something tangible. Gold sits right in that gap. That's why the $10,000 number keeps resurfacing. Not because it's a prediction someone pulled out of thin air, but because when you reprice trust in a system this large, the numbers get big fast. Gold doesn't have to go to $10,000 because Fort Knox is empty. It can go there because nobody wants to argue about whether it's full. That's a subtle difference, but it matters. Markets move on incentives, not conclusions. And the incentive right now is clear. Governments benefit from stronger balance sheets. Central banks benefit from diversification. Institutions benefit from assets outside counterparty risk. Individuals benefit from something they can hold without permission. Those incentives all point in the same direction. Slowly, relentlessly. This is why I don't think the January crash was the end of something. I think it was the start of a different phase. A phase where gold isn't just a hedge against inflation, but a hedge against uncertainty itself. Where it's not about fear, but about options. And where price moves don't need drama to justify them. They just need time. So if you're watching this and wondering what to do, Here's the grounded takeaway. You don't need to believe any extreme story. You don't need to assume fraud. You don't need to predict the exact number. You just need to recognize that the world is quietly changing how it values certainty. And gold benefits from that change almost by accident. Not because it's perfect, but because it's simple. The Epstein email didn't create this trend. It just reminded people that some of the biggest promises in the system are harder to verify than they thought. And once that realization spreads, even slowly, it doesn't reverse easily. That's why I believe gold has a long way to go. Not tomorrow, not next week, but over the years when trust keeps getting repriced higher and higher. Drop a comment and tell me honestly, should Fort Knox be audited? Yes or no? And if you want the next piece of this puzzle, where I break down the historical pattern gold has only followed twice before, and what came next, make sure you're subscribed. Because this story didn't start with a crash, and it won't end with one either.